Good evening, ladies and gentlemen. A warm welcome to all of you at ASK Investment Managers Quarterly Call. I am Gaurav Chakravarti and I'll moderate today's call. As you know, after an unprecedented run in the equity market, we are witnessing some speed breakers along the line. Now, the biggest question lies in front of us is when will the market bottom out? So broadly, there are three important factors that results in rise and fall of the equity market. First is earnings growth, second is valuation, and third is investment flows, which includes both you and me, that is domestic investors and foreign institutional investors. Again, this third factor is linked to the first two factors, that is earnings growth and valuation. Amidst all the noises around, the silver lining is that Indian economy macros are very, very strong. We have a great corporate balance sheet with lowest debt levels. Banks have a fantastic balance sheet with great asset quality. Our economy is growing at a decent rate as well. Fiscal deficit is also under control. So fundamentals are not a problem for Indian economy. The only challenge today is the earnings growth, as the valuation has also fallen significantly. Now let's understand these factors in details because the answer on market bottom would come from these factors itself. And for that, we have Mr. Sandip Bansal, Senior Portfolio Manager at ASK Investment Managers Limited with us to assess the current condition prevailing in both global and domestic market. I'll request Sandeep to take us through the highlights of our ASK growth portfolio as well. Remind you participants, ASK's growth portfolio being one of the industry's first PMS investment approach, and it has now completed 24 glorious years. And in this period, it has compounded at a rate of 19%. To put it into a number, 1 crore invested in ASK growth in Jan 2001 stands at 60 crores now. Sandeep comes with a 2 decade of work-ex with more than 15 plus years in equity market. And he has been instrumental in managing our portfolio since the time he has joined us. Sandeep is a chartered accountant, company secretary, and an MBA from IIM Ahmedabad. Today, I've scheduled this webinar where I would request Sandeep to cover the broader trends of the market and the growth drivers for Indian economy, followed by a deeper understanding of the strategies, insight on what happened in the financial year so far, where you stand now, and how you see things going forward. This will be followed by Q&A, so I request all the participants to type in your questions and queries, and we shall curate and try them answered. Over to you, Sandeep.
Thank you so much, Gaurav. Thanks a lot, everyone, for joining into the call. I'm just sharing my screen, and Gaurav, let me know once it's visible.
Yeah, it's visible.
Yeah. So, starting off with the market outlook first, globally, markets have done far better than what the Indian markets have done, especially in this calendar year. So if we look at it, India has been relatively amongst the poorer performing markets in this calendar year to date, due to the sell down that we've seen in the markets in the last 1.5 months or so, 45 days. And it has brought down the 1 year return as well. And India hence does not look that good on a 1 year basis in the global context of larger markets. While on a 3 and 5 year basis, we continue to be amongst the better performing markets. But in the near term, the sell down that we've seen has brought down our performance numbers. In fact, from 52-week highs, Indian markets, the large cap Nifty, if we were to look at the benchmark, has fallen by around, let's say, 12-13%. And, it is a double digit fall, which maybe only a few other markets have experienced. The damage has been far higher in the mid caps and small caps. Just looking at the Nifty actually does not bring the true picture. The small cap index, this data is still last week, Friday. But overall, the small cap index is down like 20% plus. The mid cap index is down closer to 20%. And these are just the indices. Many of the underlying stocks across mid caps and small caps have actually fallen far more. So just to understand what we think are the key reasons for this fall and what do we see going forward, in our view, a lot of this fall is to do with weak sentiments and liquidity in the markets. The sentiments have been weak more from a global context. There have been fears that the new regime in the US is going to be bad for emerging markets because of the tariffs that are going to get imposed. On tariffs, also, there have been multiple news flows. There could be reciprocal tariffs. There could be tariffs on, let's say, steel and aluminum, which could be about 25% for all countries. And then there could be tariffs which could start from April 25. Uh, so we really don't know what shape, size, nature these tariffs are ultimately going to be in. Hence, there is a lot of uncertainty, and obviously, markets do not like uncertainty. What we believe is that the US economy ultimately is dependent on a lot of imports from other countries, and the US would look to negotiate agreements with most of these countries because American growth is dependent on them, American GDP is dependent on them, on this fact. Inflation levels will rise significantly if very high tariffs are imposed, and a high tariff environment will also mean slower growth. So a combination of slower growth, higher inflation is likely to impact the markets as well in the US. So some or the other trade deal with various countries is going to get negotiated. There were news flows that for India, a bilateral trade agreement, the phase one of it perhaps could come by November 25. We really don't know what are the exact timelines. But a few things to think about is that India is not amongst the top three exporters to the US. Those countries are more like Canada, Mexico, China, and on Canada and Mexico, the tariffs implementation has anyways been delayed by a month. For us, US is obviously a very important trading partner. We have around 17% of our exports going to the US, and our Prime Minister has visited. Discussions are on. While there is uncertainty, our view is that the overarching goal which both the leaders have set for both the countries is that of more than doubling the trade by 2030. In the trade currently between both the countries is below $250 billion, more like 220 to 30, and the plan is to take it to 500 by 2030. And if we have to achieve that goal, that essentially implies that workarounds will be done. We think that once this uncertainty kind of settles down, and obviously it will be over a period of time, sentiments globally are going to improve, and for India as well. Then there have been concerns around the growth slowdown. Nifty and market earnings growth have again been in the mid single digits in this quarter as well in Q3 FY25. We believe that that is in line with expectations and growth is likely to pick up henceforth. A lot of the slow growth, which was either due to elections, due to heat waves in Q1, monsoons in Q2, and then a few state elections, etc., is largely behind us. So the markets have been impacted by the slowness in growth, but the outlook henceforth is looking far better. FII selling has been persistent. This has resulted in weak liquidity in the markets, bad sentiments, falling prices also impact sentiments. FIIs have been selling for multiple reasons. There is US exceptionalism, because of which a lot of the money is going back to the US. Recently, we've seen Chinese markets also doing well. Indian markets, FIIs were vacating maybe because of the higher premium that we were trading vis-a-vis other emerging markets, which has historically been the case as well, and vis-a-vis our own history also. And this amid the context of a growth slowdown and a weaker currency would have perhaps led FIIs to book profits in India and move to the US, China, or some of the other markets. If we look at the data, the currency has this is the data of the currency. We see the last 3 months have not been good for the INR. In fact, it has been amongst the relatively weaker currencies in the global context, and also on a which and the fall that we see in the past 1 year, a large part of it has come in the last 3 months. And when we see sharp adjustments in the currency, the it is natural for FIIs to intensify their selling, because ultimately what matters to them is the dollar return. So if we look at the selling numbers that we have seen since October, FIIs have been selling across various emerging markets. So it is not that only India has got impacted. As we saw, most currencies have depreciated versus the dollar. But obviously, the impact has been higher in India in the last few months. And since October, FIIs have sold around $22 billion. And in fact, about half of that number has come in the last 1.5 months. So the excuse me, the intensity of the selling has impacted sentiments and obviously liquidity as well, because the incremental domestic buyer has also become more cautious given the consistent drawdown in stock prices that was being seen in the last many weeks. Excuse me. If we look at the year as a whole as well, FIIs have sold around $10+ billion. Now, what do we think about this, and what are the other positives that we look for in the market, and what is the outlook? So, while sentiments and liquidity has been weak, we believe that the fundamentals are strong and the long-term growth story remains very much intact. Uh, if we look at some of the positives that the markets in the current mood are ignoring, both the geopolitical conflicts are on some path of resolution, because at least talks have begun. Whether it will be in the Middle East, where we've seen exchange of hostages or a ceasefire, or potential talks that are happening between US and Russia around this conflict in Ukraine. That is very good, because that helps bring down global uncertainty from in this perspective. It potentially improves the supply chain disruptions that were being witnessed, brings down freight costs, etc., which is a big positive. We've also seen crude prices being lower on a YOY basis. In spite of the conflicts, they've been range bound, which is good for global inflation and good especially for Indian inflation, because we import 85% plus of our crude requirements. In fact, the new regime in the US has said that they are looking at increasing crude production in the US by around 3 million barrels per day, which will again increase supply of oil, and hence positive for India. Obviously, this increase will happen over a period of time. The budget was also positive for the economy as a whole, and we'll discuss about it in the next slide. The liquidity situation overall was tight in the system. RBI has taken measures to improve the liquidity. That is also incrementally positive. Inflation in the country has been trending down, aided by lower food inflation. The trajectory is likely to be maintained, which is again a positive, which has helped the RBI to take a rate cut decision. While the rate cutting cycle in India is likely to be shallow, maybe perhaps another 50 basis points or so to go. The point is that the RBI is likely to be more supportive of growth if inflation remains under control, which is a positive for risk assets. Also, this quarter earnings growth has been largely in line with expectations. While it is true that the expectations itself were muted, after what we'd seen in H1, when earnings were disappointing, and while this quarter also earnings have grown in mid-single digits, the fact of the matter is that earnings per se, on a larger basket have not disappointed. And Q4 is likely to see growth coming back. What is this growth going to be supported by? We have seen government capital spending picking up. Government spending was relatively muted till November maybe, and in December we saw a good 90% plus increase. Obviously, it involved a catch-up spending of the last few months, which had not been done. We've seen rural continuing to be on an uptrend. We've seen a good wedding season. The Rabi crop is likely to be good. So all of these things perhaps make a good setup for growth going forward. The budget has also given a good boost to consumption expenditure. While on capital expenditure, the headline growth is about 10%. But if we dig deeper into the numbers, the growth is more like 17% on the capex side as well. And anyways, this is much higher than the 5% growth that we are going to see on the capital side in the year FY25. So both consumption expenditure and capital expenditure are likely to pick up going forward. And the budget has been able to do this while maintaining fiscal consolidation. The fiscal consolidation enables the macroeconomic fundamentals of the country to be maintained. It will help inflation to remain under control. It will prevent the crowding out of private sector investments. So this is a good fiscal discipline that the government has maintained while not compromising on growth at the same time. So government borrowing is also lower on a YOY basis, which is again a positive. So currently the mood that the market is in, all of these positives are getting ignored. But that is what sentiments and liquidity do. But on a fundamental basis, we believe that things will start to reflect sooner rather than later. So this is just a chart on the oil prices. As we can see, oil prices are down on a YOY basis and have been range bound. Below $80 is a good level for India. And perhaps with increasing crude production from the US, we could see a further trending down, or at least they are not going to go up significantly. Liquidity from domestic investors so far, at least till June, or the SIP data suggests that the numbers are still fine. While on a month-on-month basis, we've seen a slight dip of around 60-70 crores. But overall, at least till January, SIP data is good. While the FII data is weak, domestic liquidity continues to be supportive. Now, looking at the last piece of valuations, this number is still Jan end. As of now, Nifty is trading at around 19 times on an FY26 basis. Nifty EPS is forecasted to be around 1200 for FY26. At current levels, we are around 19 times. If we look at the average of the last 10 years, the average is around 20 and a half. So from a valuations perspective, we are below the average levels of the last 10 years. Obviously, there are many pockets in the market where the valuations are even more attractive, especially given the growth outlook. So this is on the market outlook. Now coming to our portfolio growth India Select specifically, this is the market cap breakup. The portfolio has roughly half the exposure to large caps and the balance half to mid and small caps. We do not select stocks on the basis of market caps. This is the resultant outcome based on our bottom-up stock selection. Obviously, we've seen larger pain in the portfolio from a stock market impact or a stock price impact in the mid and small cap basket. But while the stock picking is bottom up, the balance in terms of large cap and mid cap and small cap we've seen over a period of time is largely maintained. In terms of sectoral distribution, we have around 1/4 of the portfolio is exposed to capital goods, wherein we have companies in the power, cables and wires, construction materials and consumables, explosives kind of segments. Then around 11% is in infrastructure, 11% is in financials, 11% is in consumers, 10% is in manufacturing, 8% is in healthcare, 7% in automobiles, and 5 and 4 in telecom, oil and gas, and IT. So this is a relatively well-diversified portfolio, largely a portfolio which is focused on the domestic economy. A good amount of exposure is towards the manufacturing, capital goods, infrastructure side, but we also have decent exposure towards consumption, telecom, autos, and financial services. Also, we have exposure, though we are underweight. So some of the two bigger underweights that we have are financial services and the IT space. What are the stock actions that we've taken in the last quarter? So we have made these exits. We've booked profits in JSW Infrastructure, and we've exited Maruti, Narayana Hrudayalaya, Ratnamani, IndusInd Bank. We've booked profits in ICICI Bank, and we've exited Navin Fluorine. These were done largely to create liquidity for our entry into the names that we've done. Adani Ports is the largest port operator in the country. It roughly handles about 25% of India's total volumes. So as manufacturing picks up, as India's integration into global supply chains accelerate, Adani Ports is one of the key beneficiaries for the same in our view. And valuations are also quite attractive for a mid-teen kind of an operating profit growth. Dixon Technologies is the largest EMS player in the country, derives a majority of its revenues from mobile manufacturing. Its growth outlook remains very exciting. It is also getting into components, which is going to add to its margins going forward. Emcure Pharmaceuticals is amongst the top 20 largest pharmaceutical players in the country. It has about 50% of its business coming from the domestic market and about 50% of the business coming from European, Canadian, and the rest of the world markets. Earnings delivery continues to be strong, and we like the business because of its strong growth trajectory. It has about 8 brands in the top 300 brands in the country. Gravita India is a very exciting play on the circular economy in the country. It is the largest recycler with a large part of the revenues coming from lead. It is also into aluminium recycling. That business is likely to grow as hedging contracts in aluminium start to become more liquid in the market. It is also looking at entering into other segments for recycling. There is a lot of government regulation and focus to promote recycling and reuse in the country, and hence it has an exciting long-term growth journey ahead. How did the companies fare in the quarter gone by? In the quarter gone by, we saw earnings growth in the portfolio of in excess of 20% versus about 5% for the market. So the portfolio as a whole kind of delivered on the earnings expectations. The earnings growth outlook for the year FY25 also remains ahead of the market, and the same is for FY26 as well. The FY26 number looks, the differential versus the market looks even higher because there is some low base effect in some of the companies which boost these numbers. But even adjusted for that, the number growth in terms of earnings is better than the overall market. It is not that the earnings delivery forecasts are much better while the history isn't. If we look at the portfolio companies and we look at how they have delivered on their earnings in the last 5 years, we find that the sales growth of the portfolio companies has been around 18% over the last 5 years versus around 14% growth that we've seen in Nifty. Also, on the PAT side, profit side, the earnings growth of the underlying portfolio companies has been around 25% plus, which is in excess of the growth of Nifty, which is around 16% or so. And this has been delivered at good capital efficiency levels, which we can see, which is also higher than that of the market. The P ratio of the portfolio is below the average of the last 7 years. And that has been due to the weak sentiments, liquidity, etc., that has impacted the small and mid-cap space. As we saw, around half the portfolio is in that space. While the earnings have come through, the price has been impacted, which makes the P ratio where it is today versus its historical average levels. What are the key portfolio psychographics and how do we see the portfolio stack up versus versus the market and in terms of its key financial parameters? So we expect EPS growth. We've discussed earnings growth is at a 20% CAGR roughly, which is higher than that of the market. So Nifty earnings are likely to be 5% this year. Nifty earnings are more likely to be around 16% in FY26. So the portfolio in that sense compares well on earnings growth. And this earnings growth is getting delivered at a good ROE and ROC levels. The ROE levels of Nifty is closer to 16 to 17%, while that for the portfolio is much better than that. The debt to equity ratio of the portfolio is also good and better than the benchmarks. Is it coming at a premium to the underlying valuations as well of the market? The answer is yes. So the portfolio valuations are at a premium to the overall market. But we believe that given the higher earnings growth, given the better capital efficiency, given the better balance sheet, given the better free cash flow generation, and given the better management quality, and also the longer term growth outlook of these companies, the valuation differential is justified. And as we saw in the PE chart, the portfolio is actually attractively valued versus its own historical levels. So thank you so much, everyone, for your patient hearing. And Gaurav, since about half the time is over, now it'll be good to take questions from participants.
Thank you so much, Sandeep, for a detailed brief on the portfolio and the sectors as a lot. I request all the participants to type in your questions on the chat box. We shall try to curate all of them. In the meantime, we have already received a few questions. So let me start from the earnings itself, where you spoke about the earnings growth of Nifty has been in the single digit, but the growth portfolio itself has shown strong earnings growth. However, this quarter, the reflection is not there in the stock prices. Do you feel there is a mismatch in earnings versus the valuation? Or do you feel this particular phenomena is temporary and companies' growth will reflect in stock prices in a large way over the period?
Yes, Gaurav. So we would like to believe that ultimately earnings growth is which will get reflected in stock prices. That is always the case over the longer term. In the near term, the intensity of the selling that we've seen in mid caps and small caps has impacted a lot of the stock prices in the portfolio. That, as we discussed in the earlier part of the presentation on market outlook, is more to do with weak sentiments and liquidity. Are there such bouts and phases in markets which are difficult to foresee, fathom, and understand at a particular point of time? The answer is yes. Uh, but we will just have to ride through these phases and focus on the underlying fundamentals, because at the end of the day, weak sentiments, weak liquidity, or your poor liquidity amidst FII selling, etc., is unlikely to last, and ultimately fundamentals will take precedence, because earnings growth as it stands to pan out, it'll be and valuations once they start to become stabilize and become attractive, it will be factors which will be difficult for the market to ignore.
Thanks, Sandeep. We got a question alongside. I'll couple another question from another investor.
Sure.
The investor being quite a long investor with us for the last 7, 8 years. And what he says that until last year, we were consumption focused and lost probably the capital goods bull run cycle. Again, this year we have moved into capital goods. Of course, when you book profits, there's a tax repercussions as well in the portfolio. And now it seems that consumption is back. And again, we have to go by what it has been announced in the budget. Consumption can be the next theme, which you also highlighted in your presentation as well. So now the question is like, are we going in the right track?
Sure. So consumption does get a boost from the budget, and we are bullish on the consumption space, especially discretionary consumption. We have around 11% plus exposure to that space, and some of the other names that we have in terms of categorization, they could fall into different sectors. But ultimately, they have exposure to consumption as well. Uh, so, let's say just as an example, could be building materials. That could in some sense fall under discretionary consumption as well in part. Uh, it is not that, we have vacated the consumption space. We have reduced exposure because of growth or valuation concerns, and we will continue to scout for opportunities in that space wherever we believe that the price value gap is in our favor. As far as the infrastructure, capital goods arena is concerned, it is not that the budget has lowered its focus over there. In fact, as we discussed, the headline capex growth in the budget is around 10%. But if we look at it in terms of effective growth, because there are some schemes which are classified under revenue expenditure but are actually capital expenditure, then the growth is more like 17%. And this compares with the growth in FY25, which is likely to be 5%. So even a 10% growth over a 5% growth last year is much better, but the actual growth is actually more likely to be more like 17%. So there is a very good increase in capital expenditure in the economy as well. In addition to that, Gaurav, what is likely to happen this year is that private sector is also likely to uh, start to invest sometime during the year. That is also going to get aided by the rate cut cycle that has begun in the country. And the budget also highlights the fact that the center is now looking at PPP projects, and they are going to they are in consultations with the state governments to come out with frameworks for PPP projects. Obviously, these things will take time to finalize, and maybe benefits, if any, in this year are likely to be seen more in the second half of the year. But we believe that that side of the economy continues to remain very strong. While the headline has been captured by consumption, and we are well positioned there and will continue to look for opportunities, I think this is a balanced budget in which capex also gets focused. And in addition to that, state government spend on capex, PSU spend on capex, and private sector will also pick up.
Thanks, Sandeep. Again, I'll club a couple of questions from investors itself
Sure.
who are dropping the questions to us. Like, we always been on this particular virtue of capital preservation. We always given importance to this perspective. But if you see over the last specific 2 quarters, we have underperformed the benchmark, the Nifty, and more so ever the 1 year performance has been very subdued for us. If I do a, quarter to quarter or year on year comparison, the performance has been down despite the fact that we have added bountiful of stocks in the last 1 year. So what's your take? Because in certain cases where investors has come in the last 2 years, their portfolios are in the break-even range because of course the current 1 month, 2 months underperformance of the broader market as well as for the portfolio as such. Sandeep, I believe we are not able to hear you. Like I thought, I don't know the participants are able to hear you or not. I still can't hear you.
Is there? So let me
Yeah,
just
it's
get
coming
this
right
checked.
now. It's coming right now. So, Sandeep, I guess you have to repeat what you said on the question of
Sure.
performance
Sure, sure. So,
specific, which I raised.
sure. So I think, what has happened in the markets, especially in the last few months, Gaurav, which has taken away the performance or impacted the performance is the sell down due in mid caps, small caps, PSUs due to the weak sentiments and weak liquidity because of FII selling. On a fundamental basis, we remain on a strong wicket as we saw the earnings growth of the underlying portfolio companies is far better than that of the Nifty, and that outlook is likely to continue in the rest of FY25 and in FY26 and onwards as well. At some point in time, the markets will have to take cognizance of the good fundamentals of these businesses. Valuations will start to matter, and the long-term growth outlook will start to get recognized, and that will then get reflected in stock prices and portfolio returns as well. There are phases in markets where weak sentiments, weak liquidity, and these sort of challenges keep on happening. We will have to ride through these phases. Obviously, if there are any weaknesses in the portfolio, we will have to tweak that. Anyways, that's a job which we keep on doing on a regular basis. But what we believe is that the portfolio and the companies, the underlying earnings delivery continues to be solid. And once this phase is over, it will start to reflect in returns as well.
Thanks, Sanjeev. Now again, you are getting some question that, are we exiting stock uh, at the right or maybe on the wrong time? Is the timing of exit is wrong for us? We are exiting some stocks and they are going up, and when we are buying it, it's going down. So, like, your take on this particular question.
So, see, that's an
Also, I'll
observation
put in
that
this. Also, I'll put in this manner that when we are buying at a high price of those particular stocks.
see, what has happened, Gaurav, is that in the last few months, because of the drawdowns that we've seen in stock prices in the mid cap and small cap space versus today's prices, our entry prices are looking higher. Uh, while in the earnings delivery and the expectation in most of those stocks has actually come through. What we've exited is maybe a few of the large cap stocks, and large caps in the recent sell downs have relatively held on. And hence, and in fact, done better also in a few cases. And hence, it is looking as if we've sold those stocks, at the wrong time. While in today's context, that observation might look fair, but ultimately, as earnings delivery starts to come through, we would expect our underlying businesses and the stock prices also to come back. Excuse me. So, this was perhaps Gaurav in the context of the names that we've sold. So, some of the names that we've sold are ICICI Bank, IndusInd Bank, Maruti Suzuki. Those are relatively the larger cap names, which have kind of held on or done better because large caps in general have done better in the markets. And some of the names that we've entered are the relatively mid and smaller cap names which have borne the brunt of this sell down in the markets over the last couple of months. But the earnings delivery in the names that we've entered continues to remain good. And in most of the names that we've sold, in a lot of the names, large cap names that we've sold, we've actually booked profits and shifted to higher growth businesses.
Okay. Sandeep, what's your take on the mid and small cap space right now? Is it selective in nature, or we are going to see more detraction in that particular space?
See, the mid cap and small cap basket as a whole had risen and given good returns in the last few years, barring the last few months. I think going forward, the markets are likely to become more selective. Wherever there is earnings delivery, wherever there is quality of business is good, wherever there is good quality of balance sheet, wherever there is good quality of management, those stock prices are likely to recover. And wherever there is a good long-term growth opportunity, wherever there are misses on earnings, wherever the quality of the balance sheet was not good or the quality of the management was not good, therein stock prices could continue to suffer or remain range bound for a longer period of time. So, yes, the likely case in our view is going to be that the markets are going to be more selective and more choosy. In fact, in such an environment, our guess would be that growth is going to get a disproportionate premium. In fact, quality should get a higher premium in such an environment because markets are going to remain more focused on a relatively smaller basket of opportunities than a larger basket which they were earlier invested in.
Great. Uh, Sandeep, let me take few stock specific questions which we have received at our end. Also, first
Sure.
I'll go with first a question on the sector specific, then again related to the stocks. Like you mentioned that we are underweight on IT, and with the current context of the market, that can be beneficial. So our take specifically on that.
So the IT sector for us is not a very high growth sector. While it's a solid sector in terms of returns on capital management quality, but it does not fulfill our growth criteria. Hence, our presence in that sector is limited. Over there, also the name that we are invested in is a business where we believe that growth can be in excess of 15%, actually closer to 20% for a number of years. We continue to scout for opportunities in that space because we believe that India has a structural long-term advantage in the sector, but only those that can grow in that 15 to 20% kind of a ballpark region. Uh, so yes, so that is our take, and that is the reason why we are underweight on IT, and we've used that money in some sense to fund the domestic growth opportunity, whether it be in infra, manufacturing, or consumption.
Great. We have got some question on reason for getting out of IndusInd Bank and as well as for Naveen Florin.
So, IndusInd Bank, we got out because of the uncertainty around the MFI space. We were a lot of the collection efficiency stress in the sector. There were collection efficiency issues in the sector overall. The stress in the sector was continuing for a period of time, and the hence because IndusInd Bank has relatively amongst the larger banks has a higher exposure to the MFI space. We exited that name. So that was the reason for getting out of IndusInd. Naveen Fluorine is as a business, as a company, we've been holding on for a while, but that stock was underperforming, and that is because of the uh, dumping that we've seen by China in the entire chemical space in general for the last few years, because the Chinese economy did not recover as well as it was expected to, and because of which the entire chemical sector has been relatively subdued. So the stock had been a drag on our performance for a while. Lately, the stock had gone up because of news flow around refrigerant gas prices, etc., going up. But for us, the key reason for getting out of Naveen Fluorine was the fact that the business performance also was not coming through as per expectations because of this entire issue around the chemical space.
Okay. Sandeep, again, we are getting a lot of questions on stocks from the fact that a lot of our stocks are trading in red, in the current context of the market. So we are getting questions on like specific to Adani Ports, like with the current tariff and all the stories around. What's your take on Adani Port at the moment?
So, Adani Ports, as we discussed in the call earlier as well, Gaurav is the largest port operator in the country. It handles close to 25% of India's total volumes. Its peak debt is likely behind us, and it will likely to repay debt going forward. We expect a mid-teens kind of an operating profit growth in the business. This is a non-replicable kind of a business given its massive scale and size. It is about it handles more than about 4 times the volumes than its nearest competitor. This is a sector in which growth opportunities are continuing to increase as India looks to increase the proportion of manufacturing in its GDP. India wants to take manufacturing as a proportion of GDP from 15-16% currently to 25%. And manufacturing obviously entails a movement of lot of goods, as India gets integrated into global supply chains, as its trading with the rest of the world increases, the port sector growth volumes are actually going to increase quite fast. So, given the structural strength of the business, given the good returns on capital, good growth opportunity, and very attractive valuations, while the stock has been under pressure, we believe that it's a great business to own.
Okay. Your again take on Sona BLW, it's trading quite negative at the moment.
So, yes. So, Sona BLW is the quarterly results have been good. The next quarter, Q4, might not be that great because one of its largest customers is undergoing a model refresh. And when that model refresh happens, the supplies get from Sona BLW to the OEM gets impacted. But it's not it's just a 1 quarter issue. The long-term growth outlook of the company remains solid because it has got very strong, distinct competitive advantages in the differential gears and differential assembly space. It is expanding its product profile. It's a very strong player in the space, and it's the growth outlook for the business continues to remain solid. Its EV order book is actually expanding. But anyways, we always keep a track of all our businesses closely, and anyway, if we find at any point of time that the fundamentals are not playing out as per our expectations, we will be making the desired changes.
Great. Sandeep, we got a question. Like, have you entered TVS Motor right at the moment? And the question is when the prices have picked in and the two-wheeler market itself is muted. So you want to address this question?
So we just initiated a small position in TVS Motors. TVS Motors has a very solid EV portfolio. It is a good player in the exports market. It has been delivering growth ahead of the industry that it is in, and its earnings growth also continues to be solid. In fact, that stock has also come off from its highs. But obviously, if we look at it from a 2-3 year perspective, a lot of the stock prices have done well. And has TVS has done well during this period? The answer is yes. But we obviously look at how is it likely to do incrementally from our entry price point. And we believe that the business is on a very strong growth upward trajectory, both in terms of top line as well as in terms of margins.
Okay. So we got another question. Like when you spoke about EV, the obvious question goes to Sona again, right? Products of differential gearbox. Would the demand from them in the market goes down because of the EV coming in? Like, or that both stays together in the same pedestal? What do you think?
So actually, the product that Sona supplies to is for EVs, differential assemblies and differential gears. And in fact, its EV order book is actually growing. It is expanding its product suite to manufacture more and more products. So it actually does cater to the EV market as well.
Great. So it's more of a comprehensive play to
Yeah.
both the stocks at the moment, what I think.
Right.
Now, again, we got a very fundamental question, right? Which is a very quite a common for any fund manager, right? When we exit from a stock, what's the downside, or maybe the question what the investor want to ask that what is our exit strategy? And considering the current stature, because we believe that fund managers thinks a little ahead of common investors. Shouldn't we go into cash to check or protect the portfolio performance in the current context of the market?
So, Gaurav, we do not generally take cash calls. Broadly speaking, there are fund managers could be taking top-down calls or bottom-up calls. We are bottom-up investors. Market-based calls, cash calls are generally taken by fund managers who would also want to take top-down calls. Since we are taking only bottom-up calls, we generally remain invested in businesses throughout. And we do not take short-term calls in the sense that, the markets are likely to correct and hence we should, take a cash position. We would rather ride out such phases because we believe that such phases are relatively shorter in time, and ultimately earnings growth is what gets reflected in stock prices over a longer period of time. So our focus remains bottom up, our focus remains long term. Yes, these phases, when they come, they are very painful and difficult to manage. But we do remain invested at all points of time, and that has generally been our approach.
And your take on the question, the first question which you asked on the exit strategy or maybe any stop losses which we have.
Sure. So, we exit stocks whenever we believe that there is a fundamental change in the business strategy, or there is a fundamental change in the business landscape, or the valuation of the stock has become such that it actually prices in a lot more than what we think it is likely to achieve or deliver. Or if we find some other opportunity which we believe is more attractive, and since we are invested at all points in time, we have to exit stock A to buy stock B. So those are the reasons why we would like to exit a stock. We generally do not exit stocks just because let's say sentiments around mid caps and small caps are not good, or let's say the markets do not like a particular space for a given point in time. So let's say the markets currently might not be liking PSUs. So we would not generally act just based on these kind of fads or sentiments, and remain focused on the fundamentals and underlying earnings.
Thank you, Siddhi. As we are almost at the end of the webinar, I request all the participants or investors, you can reach out to us in our email addresses or to your respective relationship manager. We'd love to interact one-on-one with all of you. Request a few closing comments from you, Sandeep.
So, the underlying earnings delivery of the portfolio continues to remain strong. It was good in the quarter gone by, and it is likely to be the same in FY20, the rest of FY25, in FY26, and going forward as well. The long-term fundamentals of the underlying portfolio companies continue to remain strong. Yes, there has been an impact on performance because of the sell down that we've seen in markets, especially on the mid cap and small cap side. But we believe that that is more to do with weaker sentiments and liquidity because of FII selling rather than fundamentals per se of our portfolio businesses. And hence we continue to focus on the underlying earnings growth and the fundamentals. And ultimately, we believe that will start to reflect in stock prices as well. So thank you so much, everyone, for your time and patient hearing.
Thank you,
Have a good
Sandeep, for your
weekend.
thank you so much, Sandeep, for your closing comments. And if I have to believe what you said, that this is one of the best time, and invest in a red to enjoy the green. So thank you all the participants for attending today's call, and you shall be sharing a recording of the same. And this concludes today's call. Thank you.
Thank you.